Global stocks extend gains as major economies announce that they entered recession one after the other. Now, on the other hand, the US dollar retraces its early week gains ahead of today's PPI update as bulls and bears are fighting to keep oil prices in one or the other side of the 200-day moving average as the IEA says that supply remains ample as demand slows. So welcome to Swissquote's Daily Market Talk and happy Friday. The US stock market's performance is amazing. I mean, it amazes me, and I'm sure that it amazes many people other than myself. It looks like there is no news on the face of this world that could hammer optimism in the US big stocks. No news whatsoever, because we thought that a disappointment in the consumer inflation numbers in the US earlier this week would be a drag, but the depressed market mood lasted less than 24 hours. The S&P 500 rebounded past the 5,000 level again yesterday. This time, a mixed set of manufacturing data from the US and a drop in the US retail sales, which fell the most in almost a year, were actually brought forward as the soothing factors regarding the dovish Federal Reserve expectations. Now, the sales in the US drop. This could actually mean that the abnormally strong US spending could finally be given in, and that will obviously pave the way to earlier rate cuts from the Federal Reserve in the US than otherwise. But you know what? Yeah, right. And if they had remained strong in January, we would have just said, oh, the US economy will absolutely guarantee a soft landing, and that's really good. And the latest disappointment in the US disinflation was just a blip, and the Fed will be cutting the interest rates, the growth will be big, and then the inflation will go down. So let's continue to buy stocks. So this is where we are right now. I mean, really, we are at a point where the economic data becomes, well, meaningless almost. Whatever the data says, whatever the data prints, the US stocks find something positive to keep this rally going. Now, obviously, it's blind optimism because at some point down the road, we don't know when, but there will be a moment. You know, the emperor has no clothes on, guys, but for now it is certain that investors are blinded. They are blinded by the light that they see at the end of this tunnel that says rate cuts. So today the US will reveal the latest producer price update. The producer price inflation in the US is expected to have slowed in January, and if it didn't, well, it doesn't matter, I guess. Now, what's more interesting in all this is that, well, we know that the US growth has been very resilient last year. You know that the economy is doing pretty fine in the US, partly because, well, the US government continues to spend big, and that extra money gets soaked in the US economy and helps America to eke out a significantly better growth performance than the rest of the world. But the rest of the world is just not doing fine at all, because this week only we learned that 2 of the G7 economies entered recession. Japan and the UK entered recession. Now, Japan lost its spot of the world's 3rd biggest economy to Germany, while Germany itself is in the process of losing its own status as the European growth engine, leaving Europe, well, without a core. Really, without a strong core. And when you look at the GDP growth per head in the UK, well, the recession, some call it recession, in the UK started 2 years ago. But when you look at the stock markets and their performance, well, the European stocks extended gains at yesterday's session, and the Stoxx 50 index traded at an all-time high level yesterday, even though the fourth quarter earnings misses in the region haven't been this bad for at least 4 years, according to Bloomberg. And well, the Japanese Nikkei index is closing in on a record high as well. The index is now trading at a spitting distance from the highest level since 1990s, and that despite entering recession in the second half of last year. How come? Well, simply because the negative rates in Japan and the ultra cheap Japanese yen keep the stock prices running up a mountain. But obviously we know that the global stock markets are not breathing on their own at this high altitude, and if you pull the central bank's oxygen support, well, parts of the market and parts of these markets should come down tumbling. But don't worry, it's just a thought. No one will be pulling the rug from under the feet of investors or the stock market, so you shouldn't be worrying about that. We know that even the big shorts, Michael Burry is, well, no more short the chip stocks or no more short any stocks at all. We also know that, well, Warren Buffett sold a bit of his Apple shares, but he's got a lot of these Apple shares, and the company is feeling the pain of slowing China and the tensions that are rising with China, and that Warren Buffett prefers to increase his stake in energy companies like Exxon and Chevron instead. But Apple is trying to stay in the AI race, and it announced yesterday that it's nearing the completion of an AI tool that will eventually help developers quickly as an alternative to Microsoft GitHub. Well, that's good news. I don't know if it's going to help Apple, but Microsoft and Nvidia are clearly leading the stands, and Nvidia surpassed Amazon and Google this week to become the world's third biggest company by market capitalization. So we can't wait Nvidia to announce its fourth quarter earnings next week, because, well, that will be the big season finale for last quarter earnings. So we will see who will cry, we will see who will laugh, we will see who will stay in love, and we will see who will fall out of love. It's extremely exciting times, really, and, well, we'll see if this market enthusiasm will just continue. In the FX markets, the US dollar index retreated to 100-day moving average and sees support at this level. The euro dollar tested its own 100-day moving average resistance to the upside and sees resistance at this level. The dollar yen bulls, on the other hand, sit timidly above the 150 level, knowing that this is probably a peak or close to a peak level before, well, the Japanese officials do something to reverse the Japanese yen's sell-off, and, well, cable makes repeated attempts below its 200-day moving average, and the pair needs the US dollar bulls to make a decisive move to the upside to continue the journey toward the 1.25 psychological level. Gold, on the other hand, is back above the $2,000 per ounce, but the positive pressure in the US yields these days will likely weigh on the yellow metal appetite and eventually prevent the gold diggers from aiming for new highs, well, anytime in the foreseeable future. And Bitcoin is doing well as the ETF magic is operating after the initial drop. 9 Bitcoin ETFs that have been trading since, well, early January have already amassed $10 billion of inflows, and it's perhaps just the beginning. Elsewhere, oil bulls and bears are fighting near the 200-day moving average. Trend and momentum indicators are in favor of a further push toward the $80 per barrel level, but the roads will certainly become bumpier above this 200-day moving average and above this $80 per barrel level, because OPEC's monthly report showed this week that not all OPEC members are delivering their promised production cuts. The IEA, on the other hand, said that the global oil market may be in surplus this year because supplies outside OPEC are expected to increase by 1.6 million barrels per day, as the US, Brazil, Canada, and Guyana are pumping to fill in the OPEC's production gap. And on the demand side, while the IEA sees global oil consumption rising only 1.2 million barrels per day this year, and that's half slower than last year's increase. So, well, let's see what happens, but the $80 per barrel level looks like it's going to be a wall hard to jump over. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive messages. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.